Assalamualaikum, hello, welcome back. So I will be continuing with business combination. Okay, we'll come to the consideration transferred. Okay, what is consideration transferred? Okay, when an investor acquires a controlling interest in inquiry. Remember earlier, there are two methods in which we can control interest in the acquiry. In other words, it's called acquisition. So one of the method is by purchasing assets and also taking over liability of the company, and another method is by acquiring share capital in that company. So when we take over, definitely we have to make some payment to them. This payment will be called consideration. So it is called as consideration transferred. So for the investors, the share acquired amount to the purchase of a financial asset, namely investment. So supposingly, if I were the investor, if I were to invest in your company, so that means either I'm purchasing your asset and taking over your liabilities, or I am acquiring share capital in your company. So I must make some payment to you. So supposedly, if I were to make it by cash, this will be the transaction in the investor's account. So when I make the payment of cash, I will credit my cash account 100,000, assuming it's 100,000, and my debit side will be investment. So as an investor, I will be investing 100,000 in your account, in your company. So in my account, it will show as a debit investment, and my cash account will be credited. The consideration transferred will be measured at the fair value. So what does fair value means? Fair value is the amount for which the asset could be exchanged between knowledgeable willing parties in an arm's length transaction. Fair value can be taken to be market value. So usually fair value will be slightly lower than market value. The reason being, market value is always very speculative, meaning that the prices fluctuate according to the current situation. So sometimes it will go quite high, and sometimes it will be very low. So in order to be fair for both parties, so they will have to agree on an agreed amount. So that agreed amount will be known as fair value. So the assets will be measured at fair value. The liabilities incurred by the acquirer to the former owners of the acquiry. So when we take over the liabilities, it will be at the same amount. So if the present owner owes 100,000 to the creditors, so when we take over, it will be at the same value. So equity instruments issued by the acquirer, so that will be the purchase price for the shares, and contingent consideration. So in case if there is any other contingency expenses incurred, so this will be also included in the consideration transferred. Now we will come to recognizing and measuring goodwill or gain from a bargain purchase. So on the acquisition date, goodwill or bargain purchase is determined. The goodwill or bargain purchase is accounted for in the consolidated financial statement. Right, so let us see what is a goodwill and what is a bargain purchase. Okay. So this is a format. Okay, this is a format, but to be for us to understand it easier, we'll go into the example. Okay, this is the example. Okay, XYZ paid 50 million to acquire 100% of the issued ordinary share capital of AB on 1st November, 2005. Okay, remember 100% acquiring 100%, meaning that AB will be a wholly owned subsidiary of XYZ. Okay, XYZ paid 50 million to acquire 100% of the ordinary share capital of AB. Okay, so at that date, the carrying amount and fair value of the net assets were as follows. Okay, carrying value will be the amount recorded in AB's books. Okay, carrying value. This amount will be the amount recorded in AB's book, AB's accounts. Okay, fair value meaning, so the current price during the transaction being done. Okay, for example, like property, which is plant and equipment, not including land. The amount was 20 million recorded in the books, but in the current price, market price, it's 25 million. Okay, and the land carrying value is 10, but actually it has appreciating value, meaning it has a rise to 12, and the current assets is the same, the liabilities is the same. Okay, a brand. Okay, AB has a brand, meaning that they have a product, and the product has a certain brand which is recognized in the market. So it is not value in the accounts of AB, but when it is sold, when the company AB sold its shares to XYZ, okay, they tend to put a price on the brand name. So they sold it at 2 million. So on 1st November 2005, the directors of XYZ estimated the land to be as such and recognized a brand of 2 million. Okay, the year end of both companies is 31st December. Okay, so on 1st February 2006, that means the following year, the valuation report shows the fair value of land to be 15 million and brands at 4 million. So this you need not worry for now, because this happens the year after XYZ take over AB. So what we are concerned is in the current month, in the current year, which is the 1st November 2005. So the closing account will be on the 31st December 2005. Okay, so you need not worry about on the 1st February 2006. Okay, so now you have to calculate the initial value, initial goodwill on consolidation. Okay, so how would the valuation report affect the initial accounting? Okay, let's see. Okay, first, how do you calculate? So there is a format. There's a format, right? Earlier I've shown you the format. So now we have to fill up the format with the relevant value. Okay, cost of business combinations, 50 million. So where do you get this figure? So this figure is the amount that XYZ paid to AB. So XYZ paid 50 million to acquire shares at a value of 50 million. Okay, and the fair value. Okay, there are two values given, carrying value and fair value. But when it is sold, so when it is sold to the investor, so you have to take the fair value. Okay, you cannot take the carrying value, because if you were to sell something to me, would you sell at the same price? Of course not, because you would like to make a certain profit on it, right? So previously the property values at 20 million. Okay, let me show you. Okay, the carrying value of the property was 20 million, but the fair value was 25 million. So that person, so AB is supposed to make a profit of 5 million when they sell the property. Okay, so it is taken over at 25 million. And the land, okay, the land was previously 10, now it has appreciated in value, so it becomes 12. Okay, the asset doesn't change, so the asset is still 8. And there's a brand, okay, there's a new item, so AB also tends to make a profit on this. Okay, it's not recorded in their book, but when they want to sell it, they make a price, they put a price. So XYZ has to pay 2 million for the brand, and the liabilities taken over is 7 million. So liabilities has to be deducted because XYZ will have to take over this amount and make the payment to creditors. That means XYZ is responsible to clear all the debts owed by AB to the creditors. Okay, so goodwill will arise when your cost, the amount that you are paying, that XYZ is paying, okay, deducted from the net amount. So 25 plus 12 plus 8 plus 2 minus 7 comes up to 40 million. So supposing if I were XYZ, I have paid 50 million and I'm getting this amount of value of assets, including the liabilities. So the difference in my book will be recorded as goodwill. Okay, so goodwill will be an asset to me, to the investor, which is XYZ. Okay, then on 1st February 2006, the following year, the valuation report shows the fair value of land to be 15 million. Okay, previously it was 10, then it was transferred to XYZ at 12. Now next year it becomes it has increased by another 3 million to 15 million. Okay, and the brand in AB's account was nil, and then when it was sold to XYZ, it was sold at 2 million, and then next year it becomes 4 million. So there is an excess of 2 million here, and there's an excess of 3 million here. Okay, so how will it be recorded in XYZ's book? So remember previously they have a goodwill of 10 million. So as the adjustment is done within 12 months, so that means at the end of the year, 31st December 2006, okay, the goodwill will have to be readjusted. So how is it readjusted? So goodwill of 10 million, because this is an asset, okay, and land, surplus on revaluation is also an asset. It's an increase in asset, and the brand is also an asset, so there is an increase in asset. So because the statement of financial position has to balance both on the asset and the liability side. So on the liability side, nothing has increased. Okay, nothing has increased. But on the debit side, there has been an increase of 5 million on the land and on the brand. So something has to give. So what do you have to deduct? So the easiest, the item that you need to deduct will be from goodwill. So 10 minus 3 minus 2. So now by 31st December 2006, your goodwill will becomes 5 million. Okay, so you will adjust on the asset side, nothing on the liability side. Okay, bargain purchase. Bargain purchase is the opposite of goodwill. Okay, goodwill is when XYZ pays more for the asset that they acquired. Okay, for example, here. Okay, but bargain purchase is opposite, meaning that instead of XYZ paying 50 million, they might be paying 30 million. So if XYZ pays 30 million and the net asset is 40 million, so that means there is a credit of 10 million. So this credit of 10 million is called a bargain purchase. If goodwill is recorded as asset, bargain purchase will be recorded as a reserve, because the investor is getting a certain profit when they took over the company. So this becomes a reserve to XYZ. So this is recorded as bargain purchase in XYZ's books.